Good morning, good afternoon, everyone. Welcome to our discussion on Build-for-Rent. My name is Ryan McBride. I'm the Chief Operating Officer of CoreVest Finance, and I'm going to be your moderator today. This is the first digital version of our Investor Pop-Up series, which is co-sponsored by CoreVest and SFRhub. And it's a series that highlights relevant topics for residential real estate investors and helps connect people in the space. Prior to COVID, we had these events in markets across the country, usually over cocktails, sometimes over coffee. We can't do that right now, so here we are online and on Zoom. Today, I'm joined by a great group of experts that really cover all aspects of the build-for-rent space. People that are actually in the trenches. They're building homes, leasing homes, managing homes. Then there's those of us that are supporting them through our research, our financing, and our transaction services. So clearly Build-for-Rent is one of the hottest topics across the rental market. In fact, we've had over 1,400 registered attendees for this event today. And while our marketing team is off the charts good, it just shows you how important this topic it is across the space, and people want to learn more. I think this is going to be a great group that's going to provide you with a lot of important insights regarding the space, so stay tuned. In terms of the format, it's pretty straightforward. We're all going to go around and do a quick intro of ourselves and our platforms. Then we'll do a lightning round where the panelists are going to each highlight their outlook for the build-for-rent space. And then for the bulk of the section, we're going to engage in Q&A with questions largely from the audience. So thank you to those of you that have submitted questions. And if you have questions now or through the discussion, please submit them through the Zoom tool. Also, we're going to be doing a few survey questions throughout the discussion. So keep an eye out for those, and please participate, because it's always interesting to see what we get with those. And we'll broadcast the results real time, if you will. So let's get to it. I'll start off with my quick bio, which I'll keep mercifully short, and then we'll roll into the rest of the team here. So as I mentioned earlier, I'm the Chief Operating Officer of CoreVest Finance. We're a nationwide lender focused exclusively on real estate investors. We've been around since 2014. We've closed about $8 billion in investor loans in that time frame, and we finance a wide variety of different properties and projects, single family, condo, townhome, multifamily, even some mixed use. Generally speaking, we have two main product buckets. Our term loans, so 5 or 10 year fixed rate loans for portfolios of rental properties. And then we also, our second bucket is bridge loans. And the bridge loans are really credit lines, can be individual project financings. And those are really for a variety of different short-term lending options for a variety of strategies. So for rental aggregation, for fix and flip, and also for build to rent. So you can do the construction and you can do the stabilization under these credit lines. What we love build to rent is it allows us to really essentially smash together our two product areas to provide end-to-end financing. So you can build a home with our construction lines, you can stabilize a home on our bridge lines, and then you can roll them into long-term financing. So that's my story. I'm going to hand it over now to Mark Peterson at SFRhub, and you can hear all about him.
Thank you. I'm Mark Peterson. I'm the Director of Build-for-Rent for SVN SFRhub Advisors. We are a nationwide commercial brokerage. We also have SFRhub.com. That's our online transaction and data portal. It's also our data and analysis. The only asset class we deal with are portfolios of rental homes. So as part of that, we end up spending a lot of time working with builders and developers to help them understand what their project would look like from an investor's point of view. As a rental community, we also work with investors to help them model up and look at the differences between, say, a build-for-rent community or existing asset portfolio, and how that would compare to multifamily or retail or anything like that. So we've probably, in the last 2 years, we've underwritten somewhere in the neighborhood of 50,000 houses across the country, and probably 15,000 of those have been since mid to late March, obviously indicating a fair amount of interest. due to COVID.
Great, thanks. Don, do you want to go next?
Sure, happy to. And before I go, Ryan and Mark, thanks for having me on the panel. I'm excited to be here. It's a space that I'm definitely passionate about. So Don Walker, I'm a managing principal and the CFO at John Burns Real Estate Consulting. And our firm is solely focused on the housing industry. And we really have two sides to our business. We have a research group that publishes monthly reports on everything related to housing. A couple of our key reports would be one covers about every major housing market in the country. It's about 60 pages of all the economic, demographic, housing market related information that one would need to stay on top of the market that they build in and make great investment decisions. Then we also have reports that cover specific components of the industry, and one is the single family rental space, and we also have an apartment report, and we even have a building products report that groups like Home Depot, Kohler, et cetera, use to help guide their decisions. And then we have our consulting group, and that's where I spend most of my time. And we help builders and investors make great investment decisions related to their real estate projects. And quite often in our feasibility studies that we do, we start off with helping to determine which product to build and a strategy related to branding. And then once we nail that down, that's when we do our bread and butter work to determine what the right rents should be and absorption. And since 2012, we've been doing more and more work in the SFR and the BuildForRent space. And what I love about it is it's a new asset class, and it's not very often in real estate we get to work on a new asset class. So, Ryan, that's kind of my background.
Perfect. That's great. Colin, you want to go next?
Sure. Yeah, I'm Colin Wheel, co-founder of Mind with Doug Bryan, and we're a property management company for single family rental and small multifamily. And this is a surprisingly large and also highly fragmented space. There are over 30,000 companies in the US that do property management for this kind of small residential category. And none of them have ever scaled. The largest one has a market share of only 1/7 of 1%. And we're hoping to be the first to scale. And we think the technology exists today to really make this business make sense at scale. And there are huge advantages to having a national footprint and being able to kind of open up for investors to have one property management partner that operates nationwide. So we're full service property management, including rent collection, repairs and maintenance, and leasing. And we've developed our own technology platform from the ground up to really empower this. And so we're kind of, I think, the only, even at our scale today, which is only about 8,000 units under management, but still the only company that's really built their own technology platform from the ground up and is looking to be this sort of national large-scale company. And Doug and I previously co-founded a company together in 2009, Waypoint Homes. And we were one of the first to scale single-family rental at that time, and we grew to over 17,000 homes in our platform. And today we're part of the Invitation Homes platform. But after going public on the New York Stock Exchange and managing this fairly large portfolio, Doug and I came to believe that there's a bigger opportunity, which is really to create this first scale property management company. And at Waypoint Homes, we had participated in Build to Rent in 2013 as we were scaling up and really wanting more inventory and really, loved the Build to Rent product because it was brand new and it had high density. And so now at Mind, we have a number of clients who are Build to Rent clients of ours.
Great. Paul, do you want to go next, please?
Yeah, thanks, Ryan. Thank you, Mark, as well for having me join. Excited to be here. I manage multiple equity funds. We purchased several thousand lots and acres during the downturn. And we felt strongly that while Blackstone and Colony and guys like Ryan and Colin were aggregating on the scattered site side, we felt strongly that there'd be an opportunity to do something where stuff was built, obviously for the purposes of being rented, and started doing that in 2014. So we've round tripped multiple projects. We have approximately a 6,000 unit pipeline. We're big believers in the space. We think at the end of the day, there are a number of things fundamentally that are going to be accretive to the space, long term, both demographically. We think COVID has only proven to accelerate trends that were already in motion. And at the end of the day, we are hopefully going to be doing something. We're currently focused in the Sun Belt in the Southeast, and obviously plan to expand that. But that's given us plenty to say grace over for the time being. But it's a space we're very excited about, and have gotten out like a number of others on the panel here. We're kind of pioneers in it, and it continue to learn a lot. But it's an asset class that we felt like was going to get its own, find its own legs, and certainly that seems to be the case. And I think that's only going to continue to firm up going forward and in the future. So excited to be here.
Great, thanks. And Mitch, you're batting cleanup today.
All righty. Appreciate you guys having me on, and all the other panelists. I'm Mitch Rota, the Director of New Construction with Tricor. We're a construction service provider to the entire single-family rental space. So kind of two separate divisions that make up Tricor. One assists with a lot of the flagship REITs and new REITs coming onto the space on the renovation side. So we operate about 12 markets right now. We've been in about 16 over the course of about 6 years now, and have helped institutions turn about 20,000 plus properties in that time. And then about 4 years ago, we opened up the build-to-rent division to really take the same approach, where it was, there's a ton that goes into these projects, from entitlements to land planning to budgets to pro formas to equity debt. I mean, it's the full service of services that need to go into this, and we try to either align with partners that provide things that we can't in-house, like Don and Mark's team and Colin's team, and then also go out there and actually execute the work as the builder and contractor on these projects. So we're working on deals right now in Arizona, Texas, North Carolina, Atlanta, and Central Florida, and kind of play various roles amongst those projects, and typically try to get in super early into the projects to really help them kind of get off the ground and have the legs that they need to push forward to get to kind of certificate of occupancy and ready for lease up. Okay,
terrific. All right, well, we're going to move to a lightning round. We're going to give the team that in front of you an opportunity to talk about what they see as the future of build-to-rent, key things that everybody on this call ought to know. But first, we're going to go through our first set of survey questions. This should hopefully take a minute or two. So you can respond on screen. I'll read out the answers. So Tuan, if you could broadcast those. This is just to get a sense for who's on the phone or who's on the webinar. So I am a developer, investor, broker, property manager, or other. So if you can complete that, we'll move on to the next one. All right, so it looks like we have a lot of investors and developers, some brokers, few property managers. That's good for you, Colin, right? And then some others. Okay, my experience in build for rent involves multiple projects, single project, looking for a first project, still learning, no interest. I didn't have anything else to do. I had to look busy. Okay, well, look, it seems like we have a lot of people that are enthusiastic. A lot of people have done multiple projects, and it looks like most people are looking for their first project. So hopefully this group can help them as they go down that path. And I think this is our last survey question before we go into our lightning round here. I typically see these types of build-for-rent projects, traditional SFRs and individual parcels, flat apartments or multiple homes on a single parcel, all types of build-for-rent projects, or none. Don, I'm guessing you're going to have some commentary on these themes during your discussion in a bit.
Sure.
Just guessing. Okay, well, it looks like traditional SFR is a little bit more prevalent than the flat apartments and the single parcel. But really, it seems like everybody's seeing all kinds of projects. And I think that that's certainly true with what we're seeing in our business. And I think many of the folks on the panel as well. Great. So that's our first set of survey questions. We have another brief set a little bit later on in the discussion. So now I think what we're going to do is just going to go around the horn, what we call the lightning round, just comments on the build for rent space in terms of the outlook. I'll tee it up quickly just to provide our aspect as a lender. Just my headline is that I think build for rent is going to be the strategy of choice for most scale investors and developers going forward in the market. We've seen this segment evolve meaningfully over the last few years. It really started off as an ad hoc basis for people that had land development projects during the downturn, weren't able to really monetize them, or were looking for something different. And then it was really a defensive play. And I think as we got further into the rental model, people saw that it works. People saw that there was real demand, really transitioned into an offensive or proactive strategy, which is, I think, where the market is today. And the range of projects is really varied. We see small projects from 25 to 50 units from some of the local builders or investors. We're seeing larger projects, quite often up to 250 units by a lot of institutional players. And then we're seeing very large projects, 750 plus units from larger scale development developers. And so, we really see things across the board. And I know we're going to learn more about specific strategy as we go on here. With that, maybe we'll go back to Don just to have his quick take on this, and then we'll kind of go through the rest of the group maybe linearly through the kind of the build, development, management, and then transaction process as we look at build for rent. So Don, take it away.
All right, great. And Tuan, you have some slides that we can share, and I wanted to share these slides because it'll kind of set the stage and kind of frames how big the opportunity is, and then I'll wrap it up at the end of kind of what we've been seeing in the market as well, Ryan. So this first slide here is just to frame how big the market is. So we think there are about a little over 16 million single-family attached and detached homes in the markets. And that's out of, if you look in the kind of in the middle of the dark gray, there's 48 million households that rent, and the single-family rental space, it represents about 35% of that. So that's really what we're talking about. And it's it's larger. It's a space that has more units than large apartment buildings with 10 or more units. That only has about 15.4 million. So this is a big opportunity for people to get into. So Tom, go to the next one. And obviously, as most people know, there was a tremendous amount of growth in the single-family rental space following the Great Recession. And you can see we've had really solid growth from 2006 through around 2015, 16. And then what we saw is, there was tremendous amount of price appreciation that also occurred. And some investors, I believe, started to trim and refine their portfolios. And that's why we saw a bit of a dip. But now we are seeing growth again, and most of that is not from the foreclosure sales, but it's rather through buying homes on the MLS. And what we're talking about today is new construction of build for rent. So we think this is a growing asset class, and a lot of that growth is going to be from new construction. All right, next. And what we've seen is tremendous demand from people that want to rent homes. And so we had a low of about 90% in single family occupancy in around 2007. And now we've hit 94.4%, which is great news, because obviously this was through Q1 of 2020. And so the industry was in a good place from a fundamental standpoint, from occupancy, rents, and lease up rates. So that's the good news as we were going into the COVID situation. All right, next. So our outlook on rents, there's some negatives, but we think there's more positives. So on the negative side, as everyone knows, we've had historic job losses in 2020, and that's going to limit landlords' abilities to push rents and probably mainly on renewals. It seems from our clients that the play right now is to maintain occupancy versus rent growth. And but with all the job losses, we do expect some single-family renters that will need to trade down for a more affordable house. So that could put some downward pressure on rents. And then we also, with historical low interest rates, we're seeing that the for-sale housing market really take off. And so people are choosing to buy a home rather than rent, taking advantage of those historically low rates. The good news is some of those people that are leaving, their units are being filled by people that are coming out of apartments looking for some additional space in their home and in their backyard. On the positive side, COVID really seems to, as Paul mentioned, accelerated the trend for needing to have some extra space in the home to work, and then a little backyard to escape from the home now that we've been locked in so long. So I don't think that's a new trend. I think it's accelerating the trend. And we also think that there is going to be a shift of people into more affordable and less dense markets. So we hear about people leaving the high density living environments in the cities, looking for moving into the suburbs. And then what we think is there's going to be well, I'll skip that. High occupancy rates pre-COVID reflect strong demand heading into the recession, like I talked about. The other benefit we have is government support, and that's through the additional unemployment benefits as well as moratoriums on evictions. That has helped buoy the market in the near term. And the rent for build for rent is higher than other asset classes, standalone rental homes or apartments. And so those people that can afford to rent a build for rent typically have been less impacted in the job market. And unlike apartments, there's very little new supply, relatively speaking, in build for rent. So again, we think the positives outweigh the negatives for single family rental and build for rent. Next. And this is an interesting chart that a lot of our investor clients like to see. And what we're doing here is we're comparing the rate of change in home prices, apartment rents, and single family rents. And the single family rent is the green line. And you can see in the prior 3 recessions, the growth slowed down, but it never went negative like what we saw in the apartment market as well as home prices that were so painful. And our outlook going forward is we think that single family rents will continue to remain positive, maybe about 1% growth in 2020, 2% in 2021, and then growing from there in 2022 and 2023, which is opposite of what we're seeing in the apartment market. We think apartment rents could come down by about 4 to 5% in 2020, maybe flat in 2021 to slightly negative, and then start to recover in 2022 and 2023. Next. And one of the reasons I already talked about that people are choosing to rent a single family rental home versus an apartment is the fact that most apartments don't offer more than 3 bedrooms, whereas 65% of all single family rental homes offer 3 or more bedrooms. And again, the need for space, the need for a quiet place to work and not disturb the rest of your family members is big. And the need for privacy and extra space in the yard is hugely important to all renters, regardless of age. It could be a place for your pet, or it could be a place for your kids to get out and take a break, as well as from you to escape from the house. So that's just a couple reasons why single family rental is in such big demand. All right, next. And I'm kind of a data nerd, and so I have cobbled together a database of about 240 active build-for-rent projects, and this is just a glimpse of where they're at in the markets. And so a lot of the markets that Mitch and Ryan and Paul talked about where they're at, it's a lot of it's in the smile states. It's where it's affordable or where there's a lot of strong economic growth. So, our basic outlook is we're positive on the space. We think there could be some near-term downward pressure on rents in Q3 and Q4 if the government pulls back the stimulus and if they pull back on the moratoriums on evictions. But longer term, from a demographic perspective, from a supply perspective, we think we're in the early stages of the build-for-rent market, and we're relatively bullish on it. So that's my slide.
Perfect. Thanks, Don. Paul, from a builder perspective, do you want to fill us in on what you're seeing going forward?
Yeah, no, appreciate it, Ryan. We are there are a number of factors that we first of all, we tend to kind of take a long range view and have a longer lens. So obviously, I don't think any of us were planning on an international pandemic as a stress test to the space. But bottom line is it occurred, and we're clearly seeing the fact that the separation of the units and the additional space typically associated with the units has been very well received. Longer term trend line, we as the space continues to kind of get its own legs and achieve its own sophistication, be viewed more comfortably as an institutional asset class, we think that's only going to be accretive to growth and create more of a snowball effect. We also think kind of an underlying factor that should be hopefully very, very beneficial to the space is, it seems that the stigma associated with renting continues to erode, and with that, you're talking about what we believe is a an extremely strong alternative to a typical commoditized apartment type of experience. Number one. Number two, you typically have more space. Number three, there's definitely seemingly more of and this is across a number of different demographic strata. There's a number of people that are much more comfortable renting, and even in some instances, you're starting to see a little bit of a tone and a tenor of it being smart in its own way. So we think a combination of those factors. Obviously, no one knows exactly where this is all going with COVID. It's certainly a very there are choppy seas associated or murky waters associated with trying to predict all that. But certainly, we believe that build for rent is in as good a space as you can be, given some of those dynamics. And we are generally speaking, we're very bullish on the space. We think, 10 to 15, 20 years out, it's going to be something that hopefully, God willing, only continues to gain steam and become a more sophisticated space, which will inure to, more and more favorability from, capital that tends to, obviously, want things to be buttoned up tight and have things, kind of running a certain way. And we think that, that's only going to hopefully continue, all of the things being equal. So we're very bullish for a number of reasons such as those.
Great. Thanks. Mitch, you're also building a lot of homes. What do you think?
I agree with Paul. I mean, I think one of the key things that happened here is you sat around and watched, multiple asset classes that have been around for decades just get crushed for some time. And that capital got scared, and it's sophisticated capital. It's capital that's been in spaces for a long, long time. And when you look at, what's sustaining, I've been on a number of these panels, and a lot of the property management groups or operators have been talking about, 95 plus, 97 plus type collections through this whole entire period. And it just shows the strength of the space, which means now it's okay. There's, it's able to be, it has tested the time, as Don's charts have shown, through multiple type of recessions. Now we're in kind of a unprecedented time, and we're still holding up well. And so the dollars that are coming into this and the people that are looking at the space, has accelerated. I mean, the phone has been kind of ringing off the hook here for the last 6 weeks or so of people trying to understand what this whole thing is. And now our projects that we've been working on that kind of honestly got put on pause for about 6 weeks have accelerated quite a bit to kind of capture what's going on right now. But I don't think it's a short-term window that's happening here. I agree with everyone on the panel that it's something that's got a long road ahead of it. It's going to become part of the norm of what you go through as a person, just kind of growing in life. And this is just going to become a new product type that is entered in kind of in between, that I'm moving out of my apartment, but I'm not ready to buy, or I can't buy. This kind of satisfies that. And that population segment is massive.
Got it. And Colin, from the property management standpoint, what do you think?
Yeah. So, we're also of the same opinion, very bullish on build to rent. And, I think the real estate industry has always been an industry that's very slow to change, because people like to, it's natural. They like to see something that's worked well and then iterate again and kind of repeat the same model. And because real estate cycles, takes a while to build something and get it performing and then decide what to do next. It's just a very slow evolution. But build to rent is something that made such a tremendous amount of sense in terms of the huge advantages of, first of all, single family rental being such an enormous asset class and just recently emerging as sort of institutional grade. And then to be able to have brand new product with low maintenance and higher concentration makes a ton of sense. And there's demand for it out there clearly as people are going more and more towards renting and the stigma is evaporating. And so it seems like we're just at the very beginning of build to rent becoming a much bigger asset class, both, from scale investors and also small scale investors. And then, with regard to COVID, Paul touched on, the trends that were already in motion have been accelerated by COVID. And I couldn't agree with that more. I think, in particular, working remotely, that was something that the world has changed even prior to COVID in terms of high bandwidth, allowing video conferences like this. But, at Mind, we have about 50 engineers who are remote around the world working from home. We always had that from day one, which was about 4 years ago that we started the company. And it's amazing. They're in high definition video, it's like they're right next door. And so I think, working in offices is incredibly inefficient. And you've got the cost of the office, you've got the cost of commuting, you've got people having to live where they don't necessarily want to live. And now that society is freed up from that, I think we were on that path anyways, but now with COVID, we've just launched 5 years into the future very quickly. That frees people up to be able to live, and it's what we're already seeing with real estate prices and vacancy and occupancy, live in the more desirable sort of lifestyle cities in particular, like Bend, Oregon, which is inexpensive and for people who are into outdoor activities, is like a dream location, or Park City, Utah, places like that. Those are the places where I think there's going to be just a tremendous growing demand in coming years. And places like San Francisco, where I live, might have a lot less demand in coming years. And then the final point is just, there is, from a property management standpoint, there is the emergence of larger companies like us and some of our competitors as well, that are creating sort of institutional grade national property management platforms that haven't existed in the past. And that's another enabler of build to rent for investors that want to put money to work, but they don't necessarily want to manage the product themselves.
Got it. Thanks. And then Mark, you are probably in a position where you talk to lots of buyers and sellers more than any of us. So just curious what you're seeing and what you think going forward.
Sure, thanks. We agree with everything that everyone else has said up here so far. And, the underlying trends have been in place both from a renter perspective and, as Don pointed out, kind of the resiliency of the asset class, as was demonstrated by the last downturn. And as an attractive asset class, we view build for rent basically in the same position that multifamily was in, say, in the mid to late 80s, kind of just at the start of when institutional players are getting involved. If you look at the build for rent market now, there's tremendous amounts of institutional capital and debt lining up and trying to figure out how to participate in the asset class. And even during, kind of the start and height of COVID, there were some noteworthy headline investments. And while those discussions had obviously started long before COVID, none of this derailed the talk. So whether it's Hunt investing, JP Morgan investing, Brookfield's acquisition of Conrex, anything like that is really showing that kind of serious capital is starting to line up, starting to participate. And from the brokerage side, what was, 2 years ago, most of the investors that we were speaking with were already involved in the SFR space somewhat. And this was as a way to scale, to design a house specifically for rent instead of just acquiring a house that they could rent. To now we're talking to more and more investors who are historically investing in multifamily, in retail, to family offices doing that. And they're looking to diversify the portfolio, to add a little bit of a hedge kind of to other asset classes and to move forward. So we think it's an extraordinarily exciting time. If you're a builder developer, great time to get in, as I'm sure Paul and as Mitch said, the phones have been ringing off the hook the last 6 weeks because of all this. Right.
So maybe circling back, we'll get into Q&A here, and we'll we've got a bunch of questions, and we'll do our best to get through a lot of them. One, look, we touched on COVID a little bit. We don't want to turn this into the COVID hour. There's a lot of other things to talk about, but I'm just curious, and maybe Paul, you touched on it, but how is COVID, you said it accelerated some trends, but how has that maybe resonated with, maybe different product layouts or community layouts, or how has that manifested itself in your business?
No, it's a great question. We, as Colin kind of inured to earlier, this has kind of been a little bit of a, you're going to learn to swim quickly in a number of ways by getting thrown in the water. So, frankly, the whole idea of having, virtual tours and all these other things, it's been thrust upon everyone so quickly. So, first of all, kind of from an execution perspective, there's had to be, quick adjustments on that. I think what we have been pleasantly surprised with is people's adoption of that. And obviously I think everyone was kind of scratching their head like, okay, how's this going to go? And when is this going to kind of normalize? And quite frankly, we've had a lot of leases that have been sight unseen, a lot of stuff that has gone on, obviously, virtually and online. So it's certainly been very encouraging from that perspective. We think COVID is going to leave an imprint. We don't think it's going to be something that, is quickly forgotten. We think there are a lot of kind of, unintentional consequences, if you will, the downturn. We think the same thing is going to be here. So, I think people are much more sensitive about, where they're going to be, or when this comes up again. We tend to think that the general, mantra is, or the viewpoint is, it's going to happen again. It's going to rear its head, even if it's this or something else. So there tends to be, we think, we're hearing, quite a bit of feedback that we think inures to a trend line, which is, we need to be much more thoughtful, and we want to live in a different type of place. That's several things. One, I do believe that was already in motion as it relates to aging millennials and a number of other demographic classes. But at the same time, it's absolutely something where COVID specifically has changed people's thinking, and we think ultimately their behavior and their decisions going forward. And they are definitely looking for something that they were not looking for in January. And I think, a lot of what we're providing in this space, kind of leans into that, which is great news. Got it. Thanks.
Hey, Ryan, can I expand on that a little bit?
You absolutely can, Mitch.
So, and I think Paul and Colin both brought up great points, and it's, not only is the renter changing and demographics shifting, but it's also the process by what we go through as developer builders and operators of projects. So you're seeing municipalities change their processes. You're seeing designers change their processes, how we go about bid events, how we do open houses virtually now for entitlements and public hearings. All of that shifted inside of like 6 weeks, which, to Colin's point, it's like we advanced the industry in such a rapid way so quickly. There's still a lot of kinks to be worked out, but ultimately to become more efficient now, and all the other pieces of the puzzle, not only the demographics and people who are running these, but also how we go about as kind of builder developers and getting these projects just done quicker and more efficiently.
Got it. That's helpful. Don, I'm going to ask you a question. Andrea from Arizona kind of teed up the question. I'm going to take the essence of it. And there's been some other questions on the same vein, but it's really like, okay, the rubber meeting the road. We hear a lot about build to rent, and you had a map where you showed a lot of, dots with projects, in motion. Do you have any sort of estimate for build to rent projects that were, completed either in 2019 or maybe be completed this year, just to give, the folks a sense for how many of these actual communities are in motion and being built?
Sure, that's a good question as well. So our database shows about 240 active projects. So those are all active, up and going. I know there was another question related to that in occupancy level, and we haven't surveyed all of them for occupancy, but for the ones that we have surveyed, the average occupancy is around 97%, just to let people know that. But I would say our database is not complete. But I did a search, and there were about 30 that I know of that were completed in 2019, and about a dozen so far this year.
Mm-hmm. Got it. Okay, that's helpful. Colin, I'm going to throw this next one to you from Ty Mitchell. It's really anticipating tenant demand. How do you contrast that for larger suburban SFR style communities, relative to kind of the more denser urban styles, townhome flats? How do you see that dynamic shifting here?
Yeah, so I'm not sure are you suggesting as a result of COVID or just in general?
Well, I think in general, and as I was reading the question, I think just talking through, like, where do you see the demand, from folks? Is this kind of that migration conversation, right?
Yeah, exactly. So I think there will be, Don talked about people wanting to move to the suburbs. I'm thinking even more than the suburbs are like more low cost towns, like I was mentioning earlier, that are, highly desirable from a lifestyle standpoint and much less expensive than the urban cores. For sure, I'm a believer in that the urban core. I would not want to invest a lot in the urban core right now until at least we see how things play out with people going back to the offices, or maybe a lot of companies, like even my company, is talking about, do we really even need an office to go back to? Right. So that's argued strongly, and I think, again, as I mentioned, that's a trend that was already in play and was going to play out. It just got accelerated because of COVID. But that's a big trend in favor of the more kind of remote and cost-effective locations.
Got it. Thanks. Mark, I got a question for you from Pedro. He's asking, how does the IRR compare between build for rent and traditional MLS kind of buy for rent, assuming similar conditions, market, neighborhood, property type, et cetera? Do you have any comments there?
We think a lot of it depends on what an investor's capital stack is going to look like. If someone is buying an entire community of build for rent, there's generally more attractive permanent financing available than for scattered homes. Well, but some of it assumes you're not going to get a build for rent at a deep discount. You might be able to get an MLS home at a deep discount. Paul and Mitch are not running at 40% margins when they build a house to be able to knock it off 30% and give an investor a deal. But then on the flip side, the CapEx, the maintenance, and all of that is significantly more efficient for a whole community of build for rent than, say, the same 150 home portfolio that might be scattered around Phoenix or Atlanta or Charlotte. So it kind of depends on how someone runs the houses, how much CapEx they want to put into an existing house versus just operating and keeping it lean for a build for rent.
Okay. I want to tack on a question from our good friend David Lichtinger regarding CapEx expense for build for rent relative to, traditional SFR. How does that compare? Because I think David's saying that he's going to estimate $2,000 to maybe $2,500 per property a year for CapEx maintenance turnover. I don't know if it's Paul, Mitch, Colin, do you guys have a view on build for rent and how that might compare?
Yeah, there's absolutely no question that new product has, much, much lower CapEx, in addition to things like, the appliances have warranties, but also, there isn't likely to be much going on for at least for the first sort of 5+ years. So I would, I don't have an exact number, but I would be surprised if it's even half as much as what it is for an average SFR.
Yeah, I would agree with that. I think Colin's spot on. Candidly, it's pretty negligible, particularly when you factor in you've got warranty protection on most of your stuff that's going to cause you trouble for a period of time. So, apples to apples, clearly, in our opinion, there's a great advantage both to the attractiveness of the individual unit, coupled with from a pure quantitative expense side, no doubt it's significantly lower.
I think you're able to now pre-plan, right? What do your floor plans look like? What specs are going into them? So being able to control even the materials that are going into the houses, because they are brand new product, just kind of lends to saying that, is behind the wall, a leak happening because it's a 20-year-old product? Is this water heater going to go out in the next year or two? All of those protections are now put in place. And I think they're kind of finally starting to quantify it in terms of the kind of CapEx that are going into these as more communities come online. Got it.
We're going to pause here for a minute or two. We have 2 more survey questions that I'll ask Tuan to flash on the screen. We can do that and then maybe do a couple more questions at the end as we're getting towards the end. So COVID doesn't go away, does it? Here's a question on COVID. This is for the broader audience. The impact of COVID-19 on my business has been strongly positive, neutral, negative, disastrous. This should be really interesting to see. Yeah, I guess as expected, although the neutral is pretty interesting. There's still quite a bit of negative there, but the housing market remains strong. I think it's one of those cases where time's going to tell how it ultimately affects us. Do the next one. Okay, so we're giving everybody a crystal ball. So 2021, the real estate market will be on fire, better, unchanged, worse, or ice cold. Maybe next time we'll do this for stocks and we can see how things are going to pan out. Okay. So I think in general, I guess it's people are generally at favor. It's going to be better in 2021 to unchanged. And, we obviously have about 1/3 of the folks that think it's going to be worse. Okay, that's interesting. Okay, we got time for a couple more questions here. A couple have come up. It's just been some details, but what are we seeing in terms of the mix? And maybe Don, I'll ask you. People looking, what are you seeing in terms of the mix between 1, 2, 3 bedroom floor plans, and how do you think that might change over time?
That's a good question, and I start the answer with asking a question, and that is, what product are you talking about, and what your target is, and what your demographics are in the local area. But generally, the horizontal apartments, those are typically 1, 2, and 3 bedrooms. And when we do our studies and recommend mix, we really focus on what the demographics are. And for the most part, the greatest mix is the 2 bedrooms. Then probably followed by the 1 bedrooms and then the 3 bedrooms. But again, that can shift based on the demographics. And with regards to townhomes, I would say the majority of the mix would be 3 bedrooms, followed by some 2s. And rarely do we see a 4 bedroom. And when you're talking about traditional single family detached, it's primarily the 3 bedroom, could be a single story or 2-story, and then followed by 4 bedroom homes. And we think the trend, kind of like what people are talking about today, is that your renters don't want to pay up for extra space, right? But they do need, going forward, I think, more and more space in the home for working. So it doesn't need to be a formal office. It could be a quiet space with maybe like a barn door to close off the noise from the kids that might be in the house, or somebody else that's living with you that also is working from home. So we need to plan for those types of spaces. And again, it might not be a formal office, but it could be just a little alcove where folks can work. So again, it really depends on the product and the demographics in the area.
Right. Well, Mitch, I know you're doing a lot of building for some of the larger operators. Have they had any change in their approach to the format, or is it sticking with the model that's got them to where they are today?
Yeah, I think it's the investor types are kind of obviously dictating the product type that they feel comfortable with. So, the horizontal apartments are exactly that, in our eyes, as a pure multifamily play. So, a lot of the multifamily players lean towards that product segment because it's familiar. Maybe the debt that they work with operates in that space already. You can get the same type of financing. and the rents, demographics all play perfectly into that. Just a different spin on what the product is. And then all that whole group is kind of now shifting as well into this kind of the true build for rent and individual platted lots. And as you kind of start working from basically the land plan and the product into the actual house, we're definitely taking into account how to get creative with spaces. So to Don's point, it's how do you not add space to the floor plans, but get creative with the footprint that you have and being able to allocate spaces for a home office. Can you convert bedrooms and look at them differently? Is it better to put an office in a guest bedroom that may end up having a kid in it? Or is it better to keep it all centralized inside the master that that's kind of head of household is going to be inside that space for the most part? So trying to look at all those different pieces and when you're dealing, in the horizontal apartments and you got 650 square feet to work with in a one bedroom, it's difficult to try to find that space to get creative with. But we're kind of doing the same thing that Don said is, can you find alcoves? Can you kind of do back-to-back closets and take out half of it in the common space and turn that into a desk now instead of a laundry linen closet? Is that really needed? So tons of those decisions. And kind of to Colin's point previously, as people migrate out of the cities and looking for this kind of different lifestyle and different product type, we need to kind of change at a dime to be able to accept those people and make them feel comfortable in the space that they're in.
Got it. That's helpful. Looking at the timing here, we're through our 1 hour that's allocated. A couple of things. There were a number of questions on financing. I'm always less interesting to talk to than the rest of the guys on the panel, but just to summarize, there's ample financing in the space from us and other lenders. For construction financing, you tend to see a little bit more. You tend to have a requirement for equity generally in the 20%, 25% range. It obviously depends on your historical track record. Sometimes it can be less than that. So you're generally looking at a kind of a loan to cost of anywhere from kind of 75%, maybe 80% in certain cases. And then, that's probably true for the bridge financing. And then as you look for long-term takeout financing, you're really at a 75 loan to value ratio. Although you do have to make sure the debt service coverage of 1.2 times works. So sometimes that might, reduce proceeds a little bit. But I think given the way the space has evolved, the way projects have performed, there is quite a bit of interest in terms of not only doing the developmental financing here, the vertical construction, as well as the, I would say, the stabilization to get to rental properties, but on the long-term takeout. So financing is available. It can be, local regional banks. Again, groups like us, we kind of are a one-stop shop. And then, at some point, particularly for the larger projects, we're seeing more and more solutions, through the agencies. So that's something to keep in mind as well. In terms of the questions that were asked, we had quite a few that we got through, but there's also even more that we didn't. We're going to go through and try and answer all the questions that were presented here and email out the responses to those who didn't have their questions responded to. So if you joined the webinar, thank you for that. We will get back to you hopefully by the end of the day today. In terms of the panel, really appreciate everybody's involvement, from Mark and I, Don, Colin, Paul, Mitch. You guys, as always, are consummate professionals. Thank you very much for your insights. I don't think anybody's necessarily going viral. You weren't too controversial. So, maybe next time. This is a series after all. So maybe the next one we'll light it up a little bit more. Paul, I'm looking at you. But thanks.
I'm ready. I'm ready. I was told to keep the gloves on.
Okay. Well, we'll consider this a warm-up round. Next time we'll make it happen.
I'm happy to get after it with you, Ryan, anytime.
All right. Maybe we'll bring some dice and some cards next time. But in any event, we'll love to thank everybody for joining here today. It's a very active subject. A lot of good conversation. I'm sure there'll be many more of these. Look out for our next discussion. We'll send that around to everybody, and everybody stay safe, stay healthy. Thank you very much.
CoreVest is the leading lender to residential real estate investors. For more information about our long-term rental loans or short-term bridge loans, visit CoreVestFinance.com.